Hello guys, welcome back with the depreciation theory. We have finished with the need, causes or why we charge the depreciation, meaning of the depreciation. Now we are with what are the different methods of charging depreciation. In your syllabus there are two methods, class 11, so you need to focus on the two methods. One is your straight line, fixed installment or original cost method. There are three names with which you find this: straight line method, fixed installment method or original cost method. In this method, to calculate the depreciation, we take the cost of the fixed asset minus its scrap value upon the lifetime of the asset. If an asset's value is of rupees 5 lakh, its scrap value is of rupees 50,000 and it can be used for a 10 number of years, then what would be the depreciation amount? That is 45,000 rupees here per annum, right? To calculate the depreciation rate, this depreciation amount is divided by your asset value that was of 5 lakh multiplied by is 100. You will find the rate over here. Depreciation charged is 9% per annum. So in this case, the depreciation charge would be fixed, that I have discussed in the number of videos regarding straight line depreciation charging method with examples. Right now I am with the theory, so I will be concentrating on that only, that here the rate is fixed and it would be charged on the fixed value of the asset, that is 5 lakh. 5 lakhs, 9% would be 45,000 rupees. So this 45,000 rupees will be charged annually fixed. No change would be there in the depreciation amount. That is known as the straight line, fixed or original cost method. So in this method, what are the benefits we are getting from this method? It is a simple method to calculate the depreciation. In this question, you might be given this rate. If this rate is not given, then you can calculate in this particular manner. Second, in this the complete value of the asset is written off, because if I have written over here 10 years, that means if you prepare your machinery account, asset account for 10 years, after 10 years its asset value would be nil, would be zero, nothing would be left in this asset, right? So here it is a continuous method of charging depreciation, right? Continuously we are charging the depreciation in this method, the same all over the year. It shows the true asset value because the asset is depreciated with a single amount, so the asset value would go on reducing gradually with the single amount. Then effect on the profit would be equal every year because the equal amount is charged as the depreciation. So there is a balanced value of charging the depreciation. Then when we talk about the disadvantages, first main disadvantage of this method is this, that it is not validated by law. It is not recognized method of charging depreciation by law. Income tax of India does not recognize straight line method of charging depreciation. In Indian Income Tax Act only recognize reducing balance, written down value method, diminishing balance method as the depreciation method. Next main disadvantage is existence of asset. What existence of asset is meant? I am saying over here that in this method your asset value after 10 years would be nil. But do you think, if I say, take the example same I took in the last case, that if I am having a transportation business, my buses are running on the road, and from the books of account my asset value would be zero after 10 years, but actually the bus would be standing physically in front of me, its value is not totally zero, it would be scrapped for some value there, right? Its physical existence is still there. So that is the basic point over here, that asset exists even after writing off from the books of accounts. Then is interest on investment. That I have told you that for the point in the last was replacement of asset, right? When I want to replace my asset, I will buy a few investments. In that investment, when I am funding my money, then there would be some interest on that investment. So that interest point is not, you can say, discussed under depreciation or included under depreciation. We have not taken our interest as an income in charging depreciation. That is the point here. Then is repairs and renewal expenses. Here in original cost method, what happens? You are charging depreciation at a fixed rate, fixed amount you can say. So in this particular case, what happens that in initial years when your asset is reduced, repairs are also less. In upcoming years, repairs would add on and repairs would be of high value. But in that very years, your profits would be overburdened with your high value of repairs. The point highlighted over here is beta, it's like if I have charged the depreciation more in the initial years, then more fund would have been with me in the last years to pay off the repairs. Because I charge the same fixed amount as a depreciation, so in the later on years when repairs would be higher, there won't be much money with us to pay off the repairs. The next point is usage of asset is ignored, because here we are charging fixed amount of depreciation every time. When you are charging fixed amount of depreciation, you are not taking into account which business house is using which asset more or less. Like I have told you, I am having a buses. Now buses are running, few buses are running more as compared to the other, or if it is going to be the period of the COVID like situation where buses were not running on the roads at that time, how to take the depreciation at that time? The depreciation would be charged at the fixed road, but buses were not on the road. So what is the worth of our straight line method in that very case? That is the basic point. Now coming along, another method, that is your reducing balance method, diminishing balance method, written down value method. In this, the depreciation is always charged on the brought down value of the asset. What is the brought down value of the asset? It is like if 1 lakh was the value of asset and depreciation charge for 10%. So 10,000 must be the depreciation, and what is the leftover value of asset here is 1 lakh minus 10,000, that is 90,000. Next year we will charge depreciation on 90,000, then the asset value will left with 90,000 minus 9,000, it is 81,000. Then depreciation would be rupees 8,100. So you will see that in reducing balance method, as the balance is reducing, depreciation amount is also reducing. We are charging more depreciation in the initial years and less depreciation in the later on years. That is our reducing balance method. So in this method, the advantages are asset value will never be zero. Here the asset would be physically existing also, and in your books it would also be existing also, even with the minimal value. Second point is high depreciation is charged in the initial years. Then recognized by law. Indian Income Tax Act recognizes this method. What are the disadvantages? It is difficult to calculate. When it is difficult to calculate, when you have a number of assets you have purchased, and it could be difficult, like if I add on here one more asset, let that asset is of 5 lakh, right? Now asset is of 5 lakh. So this total would be 5 lakh 81,000. Then depreciation would be 58,100. So here he says that it is difficult as we go on next years, making additions, making deletions, it would be difficult as to recognize the depreciation belonging to different assets, and also where is the value of the different assets, because that are merged together. When they are added together, few are deducted from here, then it would be difficult to recognize the single value of the asset. And next is it ignores ROI, that is same rate of interest is ignored. ROI is, that is your interest on investment is ignored. Interest on investment is ignored, as it was the same case over here. Right. The next is suitability, where these methods can be used, your original cost method or your written down value method, where these methods can be used. If you have to pay the less amount of the repairs, you should use original cost. If your repairs are high, you should use written down value method. Why written down value method? Because written down value method charge more depreciation. The depreciation is fixed here. So it is not worthy for your high repair values. Then it is your written down. Then obsolescence, if you have more chances of technological developments, which method should be charged, used? That is your written down value, because high depreciation would be taken initially. As technology is going to change, you must have charged more depreciation, so it would be easy for you to replace the asset. Then depreciation rate, if rate is low, you can follow original cost, it's a normal asset. If your asset is of high usage, high value, then you should take your depreciation rate has to be high for your written down value method. Asset value, if you can reduce it to zero, like patents, like license, when you have taken your license, it is to run for a number of years. I have told you if there are 4 years and after 4 years that license worth would be zero, then you should go for original cost method. But if it is going to be any other asset whose value is not going to be zero, then you should make use of written down value method. Then profitability, if you are having a pace in your profits, then you should charge depreciation fixed, balanced profits you will run. But if your business is earning good in the initial years and in later on years you are having expectation of less profits, so you will prefer which method? Written down value method. Why? Because it initially charges more depreciation and then less depreciation. So here we are ended with the topic of our depreciation wholly solely. But one thing is left that I discussed in the last video about which type of land should not be depreciated. So here I have to talk about that particular type of land. So there are basically in business, you can say you hold land of two types. Usually you have learned about only land, not about these words, that is freehold or leasehold. If it is a freehold land, then no depreciation. What is a freehold? That means the land is mine, I am the owner, the land papers are on my name, I am registered owner of the land, that is the freehold land, no depreciation. If it is a leasehold land, what is a lease? Lease means you have taken the asset on rental basis for few years, right? What happens in this case, suppose there is a coal mine, right? And I don't want to extract the same. I don't have funds to extract the same or time to extract the same. So I give that coal mine on lease basis for 5 years to some particular person who is into the business of extraction of mine, right? Now for 5 years that asset is with him. After 5 years that asset would become to me. So that is your leasehold property or leasehold land. So that needs to be depreciated. On that asset you will charge the depreciation. But if it is a freehold land, then there won't be any depreciation. So that is for the day. This is the done about the depreciation theory. Upcoming videos we will talk about the more questions on depreciation. Thanks for the day. Accountitude, like, share and subscribe. Keep scoring.